All right, welcome to Mokama Sunday Service, a program that was started so that we could learn a little bit more about the stock market and investing. This is not financial advice. This is not investment advice. I am not a licensed professional. Please refer any and all decisions related to your investment and trading decisions to your licensed financial professionals. And investing is risky. So with that, let's start. I created a PowerPoint. I guess it's not even called PowerPoints nowadays. So, because I made it on Canva. Apparently, you can create PowerPoints on Canva now. So, and it was really easy. Um, Not that Canva is sponsoring this or anything. But so this is something that like I feel like we've been going over the last few weeks, and like I just wanted to kind of make it more clear, specifically because it's been a few people, my boy Chris, Ephraim, like have hit me after I've like tried to explain like bullish trades versus bearish trades when I'm talking about spreads and each side. So I kind of just wanted to make a slide presentation like that makes it easier to understand. So let me pull this down. Bullish trades. Stock is expected to go up. Like if you think a stock is going up, what trades should you be making? You should be buying shares, buying calls, selling puts, or selling put credit spreads. Bearish trades. If you think a stock price is going down or the market is going down, the trades that would make sense to take advantage of a stock price going down would be selling shares or shorting shares, buying puts, selling calls, or selling call spreads or call credit spreads. Right? So standard, everyone, when you first start, you learn how to buy shares of something, whether it's an ETF, an index fund, a stock, right? It's easy to buy shares. The things you kind of need to understand are what the bid, the ask are, and kind of what the spread and liquidity looks like in that particular stock or ETF or instrument, right? Generally, when you're buying shares, it's more beneficial to buy them close to the bid. And if you're selling shares, it's more beneficial to buy or to sell them close to the ask in terms of getting a better feel on your particular price. However, buying shares can be a high cost to really like move the needle, right? I tend not to buy less than 100 shares of something because if it moves in my direction, I want to actually make a decent profit that would actually make money. Like real money for me is not 20 to $50. It's like hundreds, if not thousands of dollars. So to make money by buying shares, there's a high cost to that because if you're buying, let's say, where's Apple at right now? Apple's at 189, 190. Let's say if Apple was at $200. If you wanted to buy 100 shares of Apple at $200, that would be $20,000. Not a lot of people have $20,000 lying around. So if you are trading using shares, it can be more costly. How do shares work? It's really simple. This is what we all know. The stock price goes up, you make money. Stock price goes down, you lose money. The risk, the defined max loss you have is the cost that you bought those shares for. So if you bought Apple at $200, 100 shares, and you spent $20,000, your max loss is $0 from that 20,000 if Apple goes bankrupt or goes to zero. I doubt that will happen anytime soon, but that's a hypothetical of like what your max loss is. Your reward is potentially infinite. Apple could go to 300, it could go to 400, it could go to 500, it could go to 1,000, it could go to 2,000, it could go to 3,000, right? Over the next 20, 30 years, right? So that's your reward for just buying shares. The second type of instrument that I use is buying calls to take advantage of a stock price or an instrument going up or something that I think is going to go up from a current level. So The skill level for this, I would say, is like beginner intermediate. It's pretty easy to buy calls, but you do need to understand a little bit about options to buy calls. You need to know whether you're in the money, at the money, or out of the money, and what those terms mean. You need to understand a little bit about the delta, or how much an option price is going to move for every dollar of stock price movement. You need to understand the theta, which is time decay, meaning the further time goes forward, the option price is likely to decrease, right? If the price stays still. And then you also need to understand liquidity. So, and this is usually expressed as the open interest in the option ladder chart. So you understand how many people are willing to buy and sell that option, so that if you are buying or selling, like how easy is it going to be for you to get in and out of that trade? Options are great because they cost less than shares, but they can move a lot faster. And you can also lose your shirt trading options if you don't know what you're doing and you don't employ things like stop losses and things of that nature. So buying a call, the stock price goes up quickly if you have a close expiration date or your option expires on that same date. If your stock price goes up quickly, you make money. If the stock price goes sideways, you lose money. If the stock price goes down, you lose money. So the risk is the max loss of the trade. So if you bought, let's say, two contracts of an option for $100 or for $1, if you understand the options ladder, it's going to be priced like, let's say it'll look like it's $1, but it's for 100 shares. So that would be $100. So if you bought two contracts for $200, that's your max loss is going to be $200. But your reward is potentially infinite if, let's say, options on Apple cost you $200 for two contracts, hypothetically, and that option doesn't expire for 6 months down the line, and Apple doubles, triples, quadruples, then you have potentially infinite upside on that option until the option expires, right? Um, However, you're going to run into expiration. A lot of people trade options on a weekly basis, on a monthly basis, or unless you're like me that trades leaps too, where your option may not expire for a year, year and a half, then that's when you can kind of really capitalize on this potentially infinite upside for buying a potential call. So that's why I buy leaps. Selling puts, also known as cash secured puts, right? Because for the average retail trader, your brokerage will not let you sell a put unless you have the cash to buy the shares if um, if the stock price is below your strike price at the time of expiration, right? This is what's called the cash secured put. So if you're selling a put and when you're selling a put, you need to understand options, same thing. But when you're selling a put, you're collecting premium like an insurance company. So you're essentially selling downside protection to someone else, and you get paid for that. Like, right? So if someone buys a put for $1, which is like $100, and then you would be the person on the other side of that trade selling a put for $100. So then when that trade is executed, they will put $100 in your account, right? Or essentially it's not in your account, but essentially you've earned $100 unless the stock price moves a certain way, right? So you're collecting premium like an insurance company. So let's say I buy Apple, or let's say I sell an Apple put at the $100 strike price, and it expires on Friday. If on Friday it is above $100 at the close of the market, then I just get to keep that $100 and nothing happens, right? Now, if on Friday Apple drops to $95, now I have to buy 100 shares of Apple at $100 I get to keep that dollar premium, but now the shares are only worth $95, right? So that's what the risk is in selling puts. The risk is owning 100 shares of stock per the contract that you sold, and it could potentially be worth less than when you sold it. So if you sold it anticipating that the stock price wouldn't go below 100, and then on Friday it's at 95, now you're going to own 100 shares of Apple for $95. And so you're going to lose that $5 minus the $1 that you collected in premium, right? So selling puts, stock price goes up, you make money collecting premium. Stock price goes sideways, you make money because you're actually taking advantage of theta when you sell puts. And if the stock price goes down, you lose money and you might get assigned 100 shares of that particular stock. When you're selling puts or selling cash secured puts, most people would say it should be on a stock that you actually intend to own. And some people use this strategy. Like right now, we've been talking about getting AMD if it drops to 146. So if I really want to buy AMD there, it might be a good idea to collect some premium at that particular strike until it hits that particular number where I want to buy it, right? And then I can collect some money on the way down. Or if it keeps shooting up and never reaches 146, then I just make like an insurance premium, right? So you got to think of the reason why puts and options were first created were for people who actually own shares of things. So let's say I bought Apple at $100 and then tomorrow it's at $200 and I gained $100 on those shares. And then earnings is coming up, or an Apple event is coming up, or the Fed chair is speaking, or something like that. And and you say, hey, I want to buy some insurance on Apple. A way that you could buy some insurance on Apple, just in case the stock price tanks, is you could buy some puts to hedge yourself against your shares, right? So that's what a lot of people do, is like if they're afraid of something happening, they'll say, hey, I'll buy some insurance on my shares. And by buying some insurance, if I buy a put, it's like buying insurance on the shares that I currently own. Now that might cost me $1, but or $100, but I'm willing to buy $100 worth of insurance to make sure that I don't lose that $100 per share that I gain by riding Apple from $100 up to $200, right? Does that make sense? Am I losing anybody?
Lots of things.
All right. DeAndre?
Makes sense.
Right.
Makes a lot.
So the last bullish trade, and these four are not the only bullish trades. There are like things you could do with butterflies and all of these other options trades that people have created that involve buying multiple options, four options, like two options at a time at different strike prices that are also bullish trades. But these are the ones that I use. Selling put spreads. So to sell a put spread, you're going to sell a put at a higher strike price and then buy a put at a lower strike price. The difficulty with this is that you need to understand options, number one, and number two, you need to track two option prices kind of at the same time, right? So how these generally work, though, is if the stock price goes up, you make money. The stock price goes sideways, you make money because you are also taking advantage of theta or time decay by selling uh, a put at a higher strike price that's going to have a higher theta attached to it than the one that you bought. And then five, if the stock price goes down, that's the only way that you lose money. So the risk here is you got a defined max loss, right? The cost of the trade. So you got capped downside. The reward, however, is that you also have defined max win. Now, if you go back to buying calls, the reason why you might want to buy a call instead of selling a put spread to take advantage of something to go up is because of the potentially infinite upside of buying a call. So, like, if you really want to take advantage of a runner, Like buying a call is the best way to do that if you really think something's going to run to the upside, like Nvidia did at the end of last year and the beginning of this year. Versus selling a put spread, even if something runs crazy, you're going to have a defined max win. So a stock could keep running and be going to the moon, but if you're already at your max win, you're not going to win any more money, right? So a put spread is a safer trade. A safer trade. It's more risk averse, but it also caps your upside as well. So it depends. So for me, it's like the trades that I'm less sure of. If I can and the liquidity is there, I'm going to more likely sell a put spread. A trade that I'm like, all of my indicators are lining up, all saying that this is going back up, I'm probably going to buy a call. Or my leap specifically. If I do a leap, I'm going to do a call because I want that potentially infinite upside, at least until the expiration date. All right. So now we're heading to bearish trades. Before I get there, any questions about those first four?
Doing good.
All right, selling shares. This is a little bit different than buying shares. That's why I would say the skill level is intermediate. It's easy to short shares, but when you are shorting shares, what you are doing is you are borrowing shares from your platform or your brokerage, and you are immediately selling them. So let's say I'm going to keep using Apple. Let's say I wanted to short Apple once it got to 200 because I think it's going to go down once it hits 200. So what I'm really doing is I'm borrowing, and let's say it's 100 shares. I am borrowing 100 shares from my platform, Thinkorswim or Schwab now, and I am selling those for 200, right? Those 100 shares for $200, for $200 a share. So that would be like $20,000. Someone else will buy that for $20,000, thinking that the price is going to go up. However, there are borrowing costs associated with that. The platform will charge you a particular fee. The more liquidity there is in a stock, like if it's a Microsoft, an Apple, or a SPY or something like that, the borrowing costs are going to be lower. If it's one of these meme stocks like AMC or GameStop, the borrowing cost is going to be higher because it's going to be more risky and more difficult to locate shares to sell and short. And then, so if you are selling shares to open your trade and you're shorting, how do you close that trade? You buy those shares back at their current price and then give them back to the platform. And you get to keep the spread if you can buy those shares back at a lower cost. If Apple doesn't go down to 190 and goes up to 220, now you have to buy those shares back at $220, which is $20 more expensive than when you sold them, and then that's how you lose money, right? So, um, another thing about shorting shares is that there's a high cost, right? Your platform is going to want to see that you have a certain amount of money in your account to cover some potential losses if you're wrong and the stock price goes up, right? So there's a high cost because if you're selling 100 shares of Apple at $200, that's $20,000. So the platform is probably going to want to see that you have 10, 20, $30,000 in your account before they let you even do this. So that's selling shares. Stock price goes down, though, you make money because if you can sell some shares at $20,000 at $200 a share for like an Apple stock, and then it goes down to 190 and you can buy it back for $19,000. Essentially, your brokerage will let you keep that $1,000 difference between the amount that you sold it and then you bought it back and then returned it to the brokerage, right? So just from like a mechanism, that's what shorting shares is. You're borrowing shares that you don't have from your brokerage to sell, and you're hoping that the stock price goes down so you can buy and return those shares at a lower price and keep the difference. Okay? And if stock price goes up, that's how you lose money. The risk, potentially infinite max loss. When you're shorting something, The capped max win is if the stock goes to zero, right? But Apple, if it's at $200, Apple could go to 1,000. It could go to 2,000, right? There's nothing stopping it from going higher, right? So that's why shorting shares or selling shares of stock that you don't own is relatively risky. However, your platform is not likely going to let you take an infinite max loss. Once it sees that your loss is exceeding the amount of cash you have in your account, they might force you to buy back those shares at whatever price they are at that time and then take that money from your account from whatever you have. Or they might force you to deposit more money in your account to cover any potential loss, right? Um, Next one is buying puts. I would say this is a little bit easier and less risky than shorting shares. Skill level beginner to intermediate. Still need to understand options similar to buying calls. The options do cost less than shorting shares, which is why you might want to buy a put. If the stock price goes down quickly, if you have a relatively near expiration date, you need that move to happen relatively quickly, you make money. Stock price goes sideways, you lose money because theta is against you in this case. And the stock price goes up, you lose money, right? The risk is a defined max loss, which is essentially how much you purchase those puts for. So if they cost $1 and you bought two contracts, your max loss is $2, or I mean $200, right? $2 times 100 shares, right? And your reward for buying puts, it is capped because it just depends on where the stock price is, right? So if Apple's at 200 and goes to $0, that's a huge win, right? Where it's almost like potentially infinite, but technically it's not infinite because once Apple reaches $1, you stop making money. But it is capped to a certain extent. But let's say you were buying a stock that was only at $5. Going to zero is where your max reward is going to be. If the stock is only $5, that may not be a lot of money versus Apple going from 200 to zero, right? But there's always a max loss where if you buy a put and at expiration, that stock price is higher than your strike price, well, you just lose that $200 you spent, nothing more, right? Selling calls. Same thing here. This is kind of a beginner intermediate strategy. Generally, your platform will not let you sell calls unless you own 100 shares of that particular stock or more. Otherwise, is what we consider a naked call. And naked calls are very risky because they're not secured by anything. That's why most platforms won't let you sell them. So you can sell calls, but most platforms won't let you sell a call by itself unless you own 100 shares or unless you're selling a spread, right? And hedging it with like by buying a call at the same time. So really, when you're selling a call, you're collecting premium, right? So it's the same thing as when you were selling puts, except now you're essentially expecting a stock price. Let's say you own 100 shares of AMD at $100 and you don't think it's going to go above 100, you think it's going to fall, right? And but yet you want to keep the shares because you believe in AMD long term. So in that case, you might sell some calls against your AMD shares to collect premium while you own them, right? So if the stock price goes down, you're going to make money. If AMD goes sideways, so you sold it when AMD was at $100 and then AMD is at 99.99 at expiration, you would still make money because you get to keep that premium that you sold. If the stock price goes up, that's when you're going to lose money and or your shares are going to get called away. So if you sold a call on AMD at $100 in terms of like you bought it for $100 and let's say the strike price was $100 in terms of the shares and AMD is 105 at expiration, then you have to turn over your shares to the person that bought the call for $100, but you do get to keep that dollar premium. So in this case, the risk is losing 100 shares of stock, but you get to keep the premium that you sold. Your reward, your potential max win could be you keep the entire premium or close to it, and you get to keep the shares at the same time. And that would be great. Like if you sold a call on AMD and the share price is $100 and you sold the $100 strike price, and then on expiration it's at 99.80. Now you made $1 off a premium, and this is just a basic example. You probably make more premium than that in reality, but you make $1 off the premium and you get to keep the shares. So you just made $100 that week and you still have the shares. And then the next week you might be able to do the same thing. And this is kind of how you earn money off of owning shares of a stock, right? The last one is selling call spreads. Is similar to selling put spreads, except you're going to sell a call at a lower strike price that's going to be more expensive, and then buy a call at a higher strike price, which is going to be less expensive. Same thing, you're going to need to track two options at the same time. Stock price goes down, you make money. Stock price goes sideways, you make money. The stock price goes up, you lose money. And the same thing with selling put spreads. This is a really risk adverse type of trade, which is why I like it. You have a defined max loss, the amount you have a defined max loss, like the total amount of a trade that you can lose, and you have a max win at the same time. So you have capped upside and you have capped downside when you're selling call spreads. But it's a way. The main difference and the reason why I love call spreads is because you have two ways to win versus one, right? If you see when you buy things, when you buy options, you have two ways to lose and one way to win. When you sell options by selling calls or selling call spreads, you have two ways to win and one to lose. The only difference is that your risk and reward are a little bit different in terms of being capped when you're selling spreads. All right. So that's the end. Any questions before we get into like some charts and stuff?
I think we good. That was good breakdowns.
Right. So I'll give you copies of the slides and stuff like that, but I just felt like I got tired of explaining this a million times. So like this is an easy way. It's not easy to understand, but like this is why I do certain things, you know. So just quickly, we're kind of at the
Hey,
end.
send that to us though.
I will. I'll export it as a PDF. Next week, just things to look at. Powell is speaking today for some reason. Um, you got some Fed chair speak, some Fed speak on Monday, Tuesday. You got jobless claims again on Thursday. Remember, like bad news is good news. So if the jobless claims come in a little bit high, kind of like they did last week, that's probably going to be good for the market. But it kind of came in line last week. And the CPI data last week came in a little bit weak. So it looked like inflation kind of came down a little bit, which is why you saw that market pop last week. Next week, in terms of earnings, here's the big behemoth reporting. We're at the end of earnings season, but you got NVIDIA reporting. NVIDIA is going to push the market up or down because it's so big. It's such a big component of the Qs, of SPY, of all these ETFs, of all these indexes right now, that if it reports amazing earnings, it could keep pushing semis and the market and tech up. If it reports weaker earnings, then people could say, hey, maybe AI is slowing down and maybe AI isn't the big cash cow that we all think it's going to be, right? But it's a $2.3 million or $2.3 trillion company. So NVIDIA, one of the biggest companies in the world right now, one of the most important companies in the world, will be reporting Wednesday. So, and it looks like it's after the bell. So that's going to be big news for the market in general. You have Target, you got some other companies reporting too, but we're kind of at the end of earnings season right now. All right. Just looking at sectors, what's been hot. Let's make sure this is updated. I told you I use this app called Koifin for that. Over the last month, utilities have been hot, the regional banks, gold has been hot, the financial sector has been hot. healthcare. And if you just look at all of these ETFs, right, most of them are above the 0% line, which is this dotted line right here in the middle. So really the only thing that's been weak lately has been oil, energy, oil and gas, but
Hold on
everything,
quick. So I just found out yesterday they charge you in California for getting plastic bottles,
yeah.
5 cents. So
Yes,
fossil
sir.
fuel makes the plastic. How much is plastic worth now, especially since we're now getting taxed heavily on getting plastic?
I'm
I
not
didn't
sure. I'm
know
not
that.
sure. I don't
I
know if that's the,
recycle and it ain't that much. It's still the
yeah.
same. I feel like it's still the same.
Yeah, and I don't think that's going to move the needle so much in the
It's
market.
$2 a case.
Yeah, but that's just that. I guess that's probably part of the inflation cost, but that's just what it is, you know? I don't know, but I don't think that's enough to really like move the market. Like plastic ain't moving the market right now. Um,
I
but
mean, I'm just in the state of California, so I'm wondering since fossil fuel is what makes plastic, I'm kind of curious as far as plastic manufacturing has that declined or not.
yeah, I just don't think that's really like really it's the price of oil that's gonna push like fuel prices, right? Like
Yeah.
and supply and demand more than anything else. Is Saudi Arabia or one of these big oil producing countries cutting supply or are they increasing supply? If they're increasing supply, then the price of oil is probably going to go down, right? If they're cutting supply, the price of oil is probably going to go
Well,
up.
no, I get as far as oil and gas. I'm saying who's the plastic manufacturing company?
That I don't know. And I don't know if they're publicly traded.
Of course not.
They could
All
be.
right,
I don't know. I don't know if they're publicly traded or not. Um,
just a random question.
Yeah. The main thing I wanted to show you is just like these sectors right now. So if you're looking at the last month, like from like the end or the middle of April to May. So if you're like, is the market going to fall anytime soon? This stuff, it looks strong right now. Most sectors look strong. Even as gold and utilities, these safety sectors are kind of high and strong. It looks like, man, a lot of the tech has kind of come up and over the last month, where's XLK? Do I have XLK? Yeah, XLK is up 5% over the last month. So we kind of had that pullback, but it looks like things have rebounded over the last month. And the strongest stuff is still utilities, regional banks, gold, real estate, financials, right? So looking at this, it looks like the Dow is probably the strongest, then tech coming in, or maybe the S&P then tech, but right now it looks good for a lot of sectors right now, but here's where all the strength is, right? And remember last week we were talking about gold. Gold popped again. Um, so any specific stocks you guys want me to look at? DeAndre, Isaac.
Let's look at on my sector. Look at alarm.com.
Man, Home Depot. I want to see Home Depot too.
You said which one?
Alarm.com.
What's the ticker?
It might be ALM.
Alliance
Um,
Mining?
no, it's not it. Um, I don't know it.
Look it up, Trey. You could Google ticker, say ticker for whatever thing
Yeah.
you're.
Look up Home Depot and then remember that.
Let's, let's talk about Home Depot, all right? So where's the 100%? So once again, if I'm looking at a stock for the first time specifically, I'm probably going to go to a 5-year month chart. Can you guys see my screen?
Yes.
Yeah.
Right. I'm going to go to a 5-year month chart. I'm going to draw my Fibonacci levels, right, to kind of figure out whether or not a stock is at a discount or how much of a discount it's at, right? Go draw the 0% at the low of 5 years is 140.63. The high was 420.61. So right now, it looks like Home Depot It's approximately like 35% off or whatever, right? If you're looking at that, it just reported earnings too the other day. So I don't know exactly what the earnings look like, but if we're just talking about the chart, so I would go from a 5-year month chart, then go to a 5-year week chart, see what it's doing on a weekly basis, right? So just looking over the last couple of months, like it looks like the end of last year up until this year was just kind of going sideways, choppy. And then it looks like it had been heading up until right before earnings. And then earnings was on, I think, Tuesday last week. Oh, this is a weekly chart. Let me go. Then it started dropping before earnings reports. 5-year day. Right here. Um, Wait, and then yeah, it started dropping before the earnings report. And right now it looks like it's consolidating. I'm almost certain that earnings were like Tuesday of last week. So it missed on revenue. Missed on revenue,
Mm.
exceeded expectations on earnings per share. I haven't dug deep into the financial reports, but it missed on revenue. Slight miss, but not a crazy miss or anything like that. So I would imagine if it reported, I think Tuesday, it's probably okay to trade this right now, but it does kind of meet my qualifications, Isaac, where I love stocks that are hitting that 200-day moving average.
Yeah, that's why I was liking that. I did a few little calls on it and then got in at the right time, and then it started booming the last 2 hours of the bell.
I do see. So this is something I would potentially like do a leap on. I love stocks personally. Like I love good companies. HD is
Here
decent.
too. So let me know about that leap if you do that, because I figured you would. That's why I wanted to see the stock.
HD is a decent company. And like I said, I love stocks that come down to their 200 moving day average. What I would want though before I decide to buy a leap in this company is I need to go look exactly like how bad the earnings were. So I do generally like Home Depot, but I need to go and see like, hey, how much cash do they have? Did they say there's a warning sign here? See, where is it? 2024 Q1. Let's go. No, this is all the fluffy stuff. Be careful of the press release sometimes. Try to go straight for the data because they'll give you like fluffy stuff. Like I just want to see the numbers. Where is this? May 17th. Yeah, so I think it was Tuesday last week. Damn it. Statement of changes. There's got to be something where I could go easily find. Quarterly earnings, webcast transcripts. So if you just kind of look at some of so their sales were 36.4, but their sales growth was minus 2.3%. So their sales went down this last quarter, but I'm really want to look at the financial stuff. Here it is. No, it's still not that. I want the spreadsheet. Um, I wasn't prepared for this, but let's see. Is it the annual report? It should be the SEC filing. I just don't know which one it is. Oh, the 10Q. But where's the the new one. Yes, there it is. All right, so it's the 10Q report. So let's remember that. Was it the 10Q or the 8K? No, it's the 8K. My bad. So we're looking for the 8K because that's generally going to give you the financial statements of the company, right? So just looking at their net sales, 36, it was less, minus 2.3%. I'm just saying, is there a reason for it other than just sales were down? Cash. They do have more cash than last year. I like that. They got 4.2 billion of cash versus 1.2 billion last year. So they have less. Their sales were down, but they have more cash. Let's see like what the margins are. What's the net earnings?
So
I don't.
stock is plastic is publicly traded, and it has no effect whatsoever.
Yeah, 3,600 divided by 36, 418. The only thing I don't like about Home Depot is their margins are terrible. Their margins are like 10%. If you do like look at how much they're keeping. So they're only keeping $3,600 or what is this, 3.6 billion of earnings for the 36 billion that they earn, that they bring in. So these are the gross margins. The gross margins, look how high the cost of sales are. So 23.9 divided by 36. So they got like 33% gross margins, and then like net margins are like less than 10%. It is a staple company, but like, yeah, I don't know. I can't say this isn't safe. This is a safe company to invest in. There's like, I don't think people are going to stop buying houses or building houses anytime soon, but it's not like the margins that AMD or like some of the chip companies have, or Apple, Google, like that's actually. So I do like where this is currently. As far like it's a better chance to like take a chance at the 200, but this stock, if you go look at the chart, and we're looking at it now, hasn't responded to the 200 as well as some of the other things that we've been looking at. You see? If you look at that yellow line,
Yeah.
I don't know. That would be my thing, is that it hasn't responded as well. And so for me, a better place to pick up Home Depot would be around this fib level right here at 280. Because if you look at bottoms here, really, if you could get it at 266 would be great. But a better level would be 280.
Okay. About to put up right now.
You could take a chance at that 200 because 200 usually does provide good support for a lot of stocks. But just me personally, I don't, Home Depot isn't tech. So its earnings aren't going to grow like tech if its net margins are like 10% versus Nvidia's margins are 80%, you know, so it's not going to grow like that. It is a safer company, but I don't know. I just kind of like it better if it hits this 50% fib level around there to like here. Personally, will it ever get there? I don't know, but it doesn't respond as well to that 200 as other stocks have been doing. Let me check the week chart.
All right, fellas, I'm out of here.
Yeah.
I'll take
All right,
care.
sir.
This is the next time. Yeah. Anything else you want to look at before we sign off? Isaac.
I'm sorry, I was on mute. Yeah, let's do Apple real quick. Apple's a good stock real quick.
Yeah. I'm still in this.
I know I saw that. I'm like, oh, I'm so mad they used to have the Apple, that Google, we still took wins off of it, but those are good trades right now.
Right there.
I was hyped too because I ended up buying more when it dipped down too, and just added more to my portfolio, my long term.
So I sold one of my calls before that event, before Apple's recent event. I made like 1,500 on that. But then I remember I bought two of these in two separate accounts. So I sold one and then I kept one. That one open is up 2,200 and this one up is up 2,200 now. And it kind of did. I sold it. Let me go pull up the day chart. We bought on one of these days down here. It's one of these days. And I think I sold it, I think on this day. I feel like the event, yeah, the Apple event, I feel like was May 7th. I saw that pop in the morning and I sold it like right around there, around 184 on that pop. And then it came down. Well, I sold one contract. So I sold half my position. Here's another thing you might want to try start doing too,
Hmm.
is if you're picking up contracts, try not to pick up just one. Try to pick
Yeah.
up two, three, four, or whatever you can afford, but at least do two. So like on Apple, I did four, but in two separate accounts. So what I did was when I got scared and I was up from here, and then we had the earnings report, and then we dipped back down, but when we came back up, and I told you like usually there's sell-offs right after earnings on Apple and after events, but I wanted to wait until right before that event on May 7th. So I sold half of my position right before that event, locked in $1,600 worth of profit, just in case this came down further. It didn't. It kept going. So now I have this winner that's up $2,200 in each account. And here's my potential target two, which is around 197,
Got it.
which is what the plan was in the first place. And the reason why I liked selling it right here is because really I wanted to swing it up from this zone up into this zone at least, right?
Hmm.
And the midpoint was around where I sold it, those two zones. So I captured and secured half of the profit. I put in uh, I think I have a stop loss. I don't see the mark here. Maybe I took it off or something. But I need to go put in a stop loss at break even, which will be probably closer to here, right? So that worst case, and I watch this every day. So if we have some massive drop on Apple, I'm probably gonna know. And Apple isn't the type of stock that's gonna drop $20 in one day. So even this was a gap up. It was due to earnings, but it's not the type of stock that drops $20 in one day. But that's kind of what I'm thinking. If it gets here, back there, that's kind of like my mental stop loss is to cut it there. But in the meantime, I'm playing on house money. I've already made $1,500 in each account off the trade, and that 2,200 is unrealized gains. I haven't like sold yet, but this call doesn't expire until June. And if it hits here, I might not sell it right there because I still might want to see if it's gonna keep running because I'm still playing with house money, you know?
Right.
I made money off of it already. I have a mental stop. It's going to go in. I think I bought it around 166.50 or something like that. I got a stop already where I know if it hits that, I'm going to get out for zero, right? So worst
Hmm.
case, I make $3,000 in two accounts on this trade. And best case, Apple
That's kind of, yeah.
keeps running, and I just let it run, you know, because it's house money at the moment.
Yeah.
So that's all I would say is if you can buy two positions, if you sell, have a target one so that when you sell, you lock in the profits. And from a psychological state, you feel way more comfortable letting it run because you already made money off the trade.
True. True. Absolutely.
So try to buy two contracts, at least two contracts or something, if not four, depending on what the price is and how far out you are. But same thing with your day trading. If let's say you were trying to buy Apple, it's at 190 right now, give or take, right? And let's say you were trying to take it up and buy a call. Maybe your first target is like 192. Sell half your position there and then put a break even stop loss on the rest of your position. right? And then just don't look at it.
Yeah, no, I
That's
like that.
that's how I've been trading a lot lately. Because if I look at it, then I'm more likely to sell early or whatever. But if the trade went right from the very beginning, because usually with options I'm trading with a 20 to a 25% stop loss.
Yeah,
If the trade immediately goes in my direction and hits like a first smaller target, I'll sell half of my position at that time to lock in a couple $100 or whatever it is, or I'll even move to break even right there. So my worst case scenario is either I make zero and lose zero, or I make a couple $100 and then lose zero on the rest of the shares or the rest of the options. But best case scenario, if I have a break even stop on the rest of the position and it just keeps running, I just let it keep running. Yeah.
no, yeah, I like that. I've been doing the same thing, but opposite way too now. So when I make a call and I'm trusting my trade because I know it's going to go up, sometimes if I'm just buying one contract, when it dips down even lower, I'll end up buying another contract for at that lower mark and ride that way back up.
That's called scaling in.
Okay, yeah. So I've
So
been doing that
scale.
too, like,
So the best way to do that too is to have a defined amount. So for me, and this new class that I'm actually taking, that's one of her big principles is scaling in and out of a trade. And so that's what you were talking about, scaling in of a trade, and I'm talking about scaling out.
oh,
So
yep.
if you're scaling in a trade, that's something else you might want to do. So like for instance, we were talking about AMD, right? So if we
Yeah, I did the scaling on AMD. That's exactly
so
what I did.
if we have AMD here and I know I want to get in around 146, I might buy, but I don't know if it's going to get there. I might buy two contracts when it gets to 148. I might allocate another two contracts when it gets to 146. And then if it gets down even lower to 142, I might allocate four contracts, and then that's a full size position. But like if it only gets to 148 and bounces up, I'm only going to have a quarter size position on. If it gets for 148 and 146, then I'm going to have a half a position on. If it gets all the way down to like the level that I really wanted, which is like 142, then I'll have a full size position on where I'll have eight contracts at different prices. And then I'll set stop losses for each of them individually, right? So if I'm willing to lose 20% or 25% on each contract, their stop losses are all going to be different based upon where I bought them. So the one I bought at 148 might have a stop loss at 140. The one I bought at 146 might have a stop loss at 138. This is hypothetical. Not, and if the ones I bought at 142 might have a stop loss at 132 or something like that, right? So that way, if I'm wrong, I'm giving each leg of the trade its own stop loss. So, and that helps with your risk as well. But yes, scaling in. I usually do that when I'm like something has hit the level, but it could keep going down a little bit further, but I don't want to miss it. And I'll set a budget. So if my budget is, hey, I can't lose more than uh let's say I don't want to risk more than 2,000 or $3,000 for this trade, I'll break up that 3,000 into percentages. So what's 25% of 3,000? What's 50% of 3,000? So on my top leg, I can only risk 25% approximately. On my middle leg, I can only risk 25% approximately. On my conservative bottom leg, I can risk 50%, right?
Right.
And then and so that's how you would potentially scale in to a trade. And how our language in our trade group right now is she calls it aggro or aggressive, moderate, and conservative. So aggressive on AMD would be 148, moderate would be 146, conservative would be like 142.
Yeah. Okay.
Yeah. So that's scaling into a trade. But you
Yeah.
also want to scale out. That's just as important, if not more important than scaling in, is scaling out of a trade. Is if, hey, if AMD is halfway to where you want it to go, maybe sell half your position, right? Get out of half, take a profit, and then put the rest to break even to wherever you got in. So you feel really good psychologically, because that's the hardest part is the anxiety when the shit's going up and down, right?
Absolutely. Yeah.
So if you can take off that anxiety off the table by knowing you already have a winner, and the worst case you set a stop at where you bought it, then worst thing that can happen is you're up a couple $100 and then the rest cancels out.
Yeah.
So that's a better way to trade. At least for me, it helps me with the anxiety of trading, especially like I told you I'm so mad I didn't buy AMD on this day. We talked on this
I
day.
know we talked about it, and then
It
so
was it
because
was
you
on
said
this
that,
day.
I did make a play on it, but I made it the next day, but I made it, and it kept dipping down, and I'm mad because I still sold a little early, but that's what I needed to start doing is
Yeah.
because I did buy like 2 or 3 because I had to buy down on that one a couple contracts. I ended up buying like 5 contracts,
Yeah.
and then I ended up.
This literally did, if like on this day or this day or this day and this day would have been good buys. This literally did exactly what I wanted it to do.
What you said, yeah, no, I watched it. Yep, I
I
ended
was
up
just
getting, I got some little money out of it. I think I made like about $300 off of that
yeah.
trade.
I should have just bought it on this day when I was talking to you guys. I should have bought it that day. I waited the next day and it took off on me, but I should have bought it
Yeah,
that day. Yeah. All right,
yes.
that's it. That's it for this week. Next week, same time, same place.
All right, family. Appreciate you. Your
All right.
knowledge.
Yep. Good.
Peace.
Good.